Welcome back. Let's talk about the new borrowings by the federal government written. The president has actually written to the National Assembly, the House of Representatives yesterday, requesting a $21.5 billion new borrowings that is expected to fund a couple of things. And there's another borrowing that has to do with pensions and all of that. We're going to break it down on the program. But this has gotten a lot of Nigerians talking, given where we're coming from. With the experience of the previous administration that this administration had to deal with. And towards the end of the last administration, there was a securitization across 40 years just to make sure that is sorted out in terms of our ways or means that was totally reckless in how it was managed. Let's bring in our professor, President, Nigerian Economic Society, Professor Adiola Anedikinju. He joins us virtually. Prof, thank you so much for coming on the program.
Thank you very much for having me. Good morning.
Prof, I think, the always natural way is your quick reaction to this new borrowing. I was listening to a few people. Nigerians are already angry because they are going through so much. They are not seeing the results that they expect to see. The government is saying, hold on, it's going to come. Just relax. These are the, painful season of the reforms. And Nigerians are not seeing new borrowings. Whether the intent is good or bad, Nigerians don't want to hear. So what do you make of this new borrowing, sir?
Thank you very much, Jeff. I think understandably, maybe a lot of people will be worried. And the reasons are very clear. The pile-up of debts, in the last couple of years, is getting a lot of people concerned. Because debt is not a free lunch, it's going to be paid for. Either by the present or the future generations. It's also when you are going to service the debt, it's going to be at the cost. For instance, if you look at the budget this year, the debt servicing, overwhelms even capital expenditure. So it's a very serious business that has to be given very, very deep analysis. It has to be done, with great concerns. And if you look at the current days, the current loan request by the Mr. President, $21.5 billion, that's a whole lot of, lot of money. The current external debts, depending on where you look at, is around $45 billion. So if you are going to bring in almost $22 billion in 2 years to add to that stock, that is about 60% leap. That is huge, that's massive. And therefore, it is very important that, a deep analysis is done. Nigeria should be told why this plan to be contracted. Though some of the reasons we know, the 2025 budget is going to be difficult to implement because a lot of the parameters are not just working, in reality. And therefore, you need to get some revenue to ensure that the budget is implemented to some level of credibility. And if you don't want to increase tax, your tax rate, then maybe debt is the option that the president is going for. But that raises a lot of questions.
Prof, they've highlighted a few things, the reasons for the borrowing. They said the significant infrastructure deficit, paucity of financial resources, declining domestic demand. And so this has caused them for prudent economic borrowing to close the financial shortfall. And they also recognize the fact that this will increase public debt stock as well as debt servicing obligations. So let's go back, Prof, to the very beginning. This is 2 years down the line. Exactly tomorrow will make it 2 years down the line since its administration. Where did they get it wrong in budgeting for 2025? The reason I ask, because I listened to Okonjo-Iweala, the former Minister of Finance, who is the WTO DG, and one of the things they did then under the Obasanjo administration was actually to do some delinking of the budget from volatility of oil price. So simply what they did was to be less ambitious and put oil price as low as it can so that the fluctuation and volatility doesn't affect it, which we now have the excess funds that we use to buffer our external reserve. Do you think this budgeting process was too overambitious and wasn't well thought through? That's why we're here. And what does this say for the nearest future?
Yeah, I mean, that is a very important point that you just made. If you are dealing with a commodity that is very, like oil, Oil is a very volatile, commodity. And we've had experience in Nigeria. I remember, we went through a process of this volatility that led to huge debt accumulation when we had to get debt forgiveness and so on and so forth. So during this development plan, as it were at that time, it was, the oil sector was ring-fenced, okay? So that the economy's growth is not going to depend on on what happens in the oil sector. So the price was capped, the output was capped, so that the economy will be driven by the non-oil sector, not the oil sector. Two, like Riley said, the oil price, benchmark under the Okojo Wella was deliberately set very low, okay? So that you mitigate, the possible effects of volatility on the economy. And that helped us at that time to build, the excess food account that, accumulated over $20 billion at some point and helped us through the 2008 global, financial crisis. But subsequently, and the last couple of years, we are not doing that. Both the price and the quantity are ambitiously, specified in the budget proposal, so that it becomes extremely difficult to meet them, and hinder us from being able to build a fiscal buffer. And one thing I say about the current government is that it's like they are very ambitious. They want to do so many things that and that is really leading to a whole lot of these challenges that they are faced with. We've just removed fuel subsidy. Last 2 years ago, the fuel subsidy was removed. Okay, adjustments have been made in energy prices. Exchange rate has been unified. Now, these have brought massive revenue to government. So revenue has increased significantly. So the question is, why do we then still need to amass all of this debt, at the same time? Okay, so that is really a real challenge that we really need to. There's nothing wrong as economists. We don't say that debts are wrong in themselves, okay? But there are a lot of parameters we have to look at to be ensured that this debt that you want to accumulate, the net impact of the economy is going to be significantly positive in terms of job creation, economic growth, infrastructural developments, export diversifications, and the rest of them. There are a lot of metrics we have to. And then you also have to look at how do you pay back these debts? Okay, is the debt going to crowd out private investment? Is it the debt going to lead to give you foreign exchange risk? Because when you are paying back, that's going to be some massive, demand on your exchange, or your exchange rate, and so on and so forth. And is it going to crowd out capital, the interest rates? Will it crowd out capital investment in education and the rest of them?
Well, Prof.
Then, how you ensure that this thing will be repaid? Okay, yes, quiet, please.
Pardon me, I just wanted to link this to the bigger picture, which I think you made reference to. On the one hand, it's been said time and again that borrowing is not bad, but the challenge is usually what is it used for, what kind of effect will it have? We've gone down this road before, and a lot of times when we look back, it's still a lot of regrets, uncertainty, lack of clarity. You can't even see some of the projects that these borrowings were meant to, be for in the past. But the big picture, as I've said, that Nigeria needs about $3 trillion over the next 30 years to plug its infrastructure gap. Recently, the Minister of Power was saying Nigeria needs $10 billion yearly for the power sector if it at least wants to make significant improvement. So we have a huge infrastructure deficit, housing, the roads, and all of that. And I think in the letter, which was read by the President of the Senate, he said that the funds, that's the borrowings for 2025-2026, will primarily be directed towards critical infrastructure projects, including sectors of power, railways, healthcare, amongst others. While this is now before the Senate's Committee on Local and Foreign Debts, we hope that they will do a good job. My question to you, Prof, is, so what must we do differently this time? Because this burden is huge. Children, maybe grandchildren will probably have to pay this. So what must be done differently from your perspective, seeing that we have a huge infrastructure deficit?
Yeah. Thank you very, very much, Claudia. I mean, that's an excellent question. And that's why I refrain from saying it's bad, because again, if you look at the metrics, like I said, the minimum debt GDP ratio, if you look at the fact that, we have all of the infrastructure deficit, the fact that, even 2025 budget is difficult to be implemented with the current reality of the oil sector and so on and so forth. So that, and because, this government also had a lot of ambitions in terms of, some of, putting in place infrastructural development and the rest of them. So what must we do differently? You see, I mean, my point has always been that the National Assembly should also have a complementary body within the National Assembly that can, that can put all of this debt into deep, thorough analysis, empirical analysis. In the US, you have a body, CBA or whatever it is called, that has its own models, or that run this modeling or this desk and look at the implications on the economy, the macroeconomy, to be able to answer the questions whether it is really worth us taking this debt. The federal government has said, oh, we have done our own analysis. It's going to impact on employment. It's going to do all of A, B, C, D, and E. Now, those who are going to approve that loan should also be able to put all of these loans through its own independent analysis that will come out with what to be the impact on this debt on all of those macroeconomic outcomes and the repayment of those loans. That has to be done. Two, it is not only government alone that can build infrastructure. It's only government alone that can intervene in a lot of these sectors. You must create the incentives that allow the private sectors to come and play. Okay. I mean, we have a whole lot of things going on in the what's it called, telecommunication sector, fixed sector. The government is not there. So how do we put in place the incentive structure that allow the private sector to be able to come and play? I mean, if you look at the demands for some of even the local bonds and the rest of them, you will see that there's a deep fund, there's a deep money in this country, that is waiting for where to invest. So let's create those infrastructure. And there are so many institutions that government had created, that also drive some of these investments, okay? In the PPP fashion, or, provide some basis for the private sector to come in. This country is huge. Electricity could generate a lot of money. Transportation could generate a lot of money, if we create those infrastructure for the private sector. And two, is that we must ensure that, for this debt for us to easily to repay, this economy must go at certain rates. We must generate at least 4% GDP growth rate continuously, minimum, to ensure that the payment of this debt does not impose some burden on Nigeria. So what are we doing to be able to achieve all of that? So there's a lot of needs, the gaps are there, but it's not always that government sector, the public sector, and because again, if you look at the public sector, the inefficiency of public sector is also always there. In Nigeria, it has been certified that Nigeria has one of the highest costs of public infrastructure in the whole world, not just in the whole world. The cost of building road in Nigeria, public roads in Nigeria, compared to other parts of the world, is one of the highest, and the quality is not even also as good. So we need to find a way of ensuring that we get other, non-government agents, actors, to be able to participate in this infrastructure development and other areas.
Quite important points there, but let me ask you a very candid question. With the setup of the government as you see it now, the president, his cabinet, the National Assembly meant to perform oversight functions. You've talked about the MDAs and the rest. Does this government strike you as a prudent government that you can trust with this quantum of funds to be able to efficiently and effectively manage it?
The way to answer that question is we should put in place institutions. It's not about the individual government. Tinubu government will come and go. In fact, that's why we need to ensure. You see, when you incur debt now, it also imposes some constraints on government that are coming after you. Okay, or some obligations in terms of how they're going to perform. If you have government that will not perform well, okay, even after you may have very good and noble ideas when you incur those debts. Now, these are long-term debts that require some payment structures, some obligations. And after you live for 8 years, how do you ensure that the government that will come after you will be so prudent, will be so efficient, as to be able to, ensure that these debts are paid back without, putting a lot of problems on the future generations. So you cannot guarantee what will come after you. So the important thing is to put in place the institutional structure. And the last time I had, I had to want you to address the Senate, during the 2025 budget. I insisted that they must create an institution that allows them to be, to be independent in a way to be able to analyze all of these policies, 10 years, 5 years, 10 years to this. To this point, because this debt is not just a short-term impact, it's going to have medium, it's going to have long-term impact, and there must be a way of quantifying all of those impacts, and to be ensured that there are conditions that are in place, there are shares that are in place, issues around transparency that are in place to ensure that all these debts are paid without imposing unnecessary burden on Nigeria. And two, that we can see the infrastructure, we can see the agricultural intervention, we can see all of these other things that those debts are, are used for.
All right.
So accountability is very important.
Okay.
Very important.
Yeah, Prof, thank you so much for your insight. In fact, I'm looking at it again. I just know that the government needs a lot of work in terms of fiscal management. I'm looking at 757 billion naira pension bond. And this is because they've been struggling across different administrations to meet pension obligations. So technically, we are borrowing or floating this bond, which is a smart way to do it, to be able to meet recurrent expenditure. I don't know. It's just worrying. Prof, thank you so much for coming on the program and for your insight. For as much as possible, we'll bring you in to give interpretation to some of these things that Nigerians struggle to, get to understand because they expect a lot more from government. Professor Adiola Adenikinju, President, Nigerian Economic Society, thank you so much for joining us on the program.
Thank you for having me. Thank you so very much.
And from here, we'll take a break. When we come back, we'll get to the pages of the social media. That's how we choose to call it right here on the program. Join us again.